Building a repeatable options trading process. We want consistent results, isn't it? I guess it's fair to say that requires consistent action. Random action would very likely lead to random results unless one is lucky every day of their life. Whereas consistent action gives a chance to our trading approaches to produce consistent results. Of course, depending on the market and the pros and the cons and characteristics of the options strategies being used. But without that consistent action, it would be very difficult, isn't it? Anyway, so let's get started here with how to put together a framework that would allow you to be a rule-based systematic options trader. On the left, we have a pretty erratic trader that applies discretionary methodologies, and that maybe could be okay, but in this case the execution is emotion driven, the strategy selection is random, sometimes it's a long call, sometimes it's shares, sometimes it's a short put, randomly with no specific reason. Position size varies, some trades are buying one call only, some trades are buying 50 calls. And on top of that, there is no post-trade review to learn from experience, learn from mistakes, and learn from good practices. So I think it's pretty obvious that the guy on the right is going to have a much easier time compared to the guy on the left, isn't it? The person on the right has predefined checklists, has a structured way to decide which strategy to employ. When it comes to position size, it's mathematical, so you have a number you cannot surpass and you just make sure you don't surpass that number. It's not about how you feel. And then we journal and we review the trades all the time, so we can continue growing and be in tune with the markets and identify if we are falling into some sort of a pattern that may lead to future losses. So you may want to think about your trading process as a loop that has a starting and an ending time. Number one would be to identify an opportunity. Of course, we need to have a set of rules that allows us to analyze the market. You may be using indicators, you may be using technical analysis, you may be a fundamental trader, you may be a quantitative trader. There are many ways on how to approach trading, but you need to have one way on how to get started that tells you, hey, that's a trade. That meets your rules, get ready to trade. The moment we get that, we need to do step two, plan and select the strategy. So we have a trade, but is volatility expensive? Is volatility cheap? Is it time to buy options? Is it time to sell options? What should we do? So that would be your step two when you select the strategy that you're going to use, the option strategy that you're going to use. For example, long call. Number three, size position. How many calls are you going to buy? Right? We need to decide that, and we'll discuss it more in depth in a moment. Then we manage risk, quality control, right? So we are in the trade. Do we use stops? Do we enter a collar or buy a put if the market goes against us? All of these needs to be predefined. And finally, we are out of the trade. We then track and review what happened, how did we treat and manage the situation. And again, we will identify for sure things that we did perfectly well. We may also identify things that are improvable and we need to work on getting better at. So a trade does not begin at execution. Execution is merely step three in a continuous engineered loop. It never stops in a way. You're out of the trade, but it goes back to, okay, now we're entering the new trade. So it's a loop. When it comes to understanding your strategies and the options that you have, we need to be systematic. We cannot just pick, okay, so I want to do a cash secure put, or you know what, today instead of a cash secure put, I feel like doing a long call. You know what? Both could be seen as bullish. I get it. But the reason why you would do it is totally different, right? For example, if we are dealing with a market which is bullish within a directional market environment, and you are bullish, you can buy a call or do a synthetic long. That gives you tons of delta, which is 100% in line with the fact that you are in a directional environment. Now, if your environment, instead of purely directional, was either volatile and you don't know where it's going, or just neutral, like it's ranging or falling a little or rallying a little, maybe you're in this neutral mode and you end up doing a cash secure put, which is also going to give you positive delta, but much less. A long call may give you 50 delta, where a cash secure put may give you 20 delta only. So it depends on your strikes, of course. But the point is that we should have, as part of our trading rules, a table like this or similar that tells us, depending on the market condition, depending on the market environment, and depending on your market direction or lack of direction, which strategy are you going to use. So if the market is clearly trending and you have directional opportunities and they are bullish, buy call or buy synthetic longs. If the market is going down, it's a downtrend, it's bearish, so you buy a put. Simple. If we are in a situation where the market is very volatile, you don't know where is it going, but you have this potential for profitability through magnitude of a move instead of direction, so you would then do your straddle or strangle, or you would then enter some either more conservative strategies like a cash secure put, or if you are even more concerned, you would then add your cover calls or your collars to add protection in such a neutral market condition. So we need to align the outlook to the tool. The tool in this case is going to be the options strategy. Long call, long put, synthetic long, long straddle, long strangle, cash secure puts, cover calls, or collars. We don't force a strategy into the wrong market environment. It would not make sense that you tell yourself, I love cash secure puts. I'm going to do cash secure puts for the rest of my life, no matter what. It makes no sense. It's a beautiful strategy. One is really beautiful. It's really beautiful when you apply it to the right market environment. So you get great levels of premium because implied volatility is high, etc., etc. If you were to do cash secure puts in the wrong environment, probably you will not like it as much. So we need to be adaptable, and we know our basics here. The long call, where the market goes up, you profit, and if it goes down, the most you can lose is limited. Okay, and the long put, where if the market goes down, you profit. Here we go, right here. But if it goes up, then the most you can lose is limited. That would be your long call, long put. Then for the cash secure put, notice how the risk profile graph looks like the cover call, because to be honest, it's the same. If you think about it, it's the same. So even though the cover call is done with a stock and a call instead of just selling a put, but the risk profile is the same. The most you can make when you sell a put or you do a cover call is the premium collected, right? And if the market goes down, you lose. You have a buffer that allows you to be wrong by a certain amount, but you lose. Whereas the long straddle, you make money in both directions, no matter what, as long as the market moves far enough. If the market stays between the break-even points here in the middle, you're gonna potentially lose a decent amount of premium, which is decent in the sense that you bought two options, a call and a put. So you are paying double the premium, not exactly double, but in a simplistic form, we could just think about this double. So having a pre-flight checklist, it's important. You cannot just enter the market and let's see what happens. So which strategy do I feel like trading today? And it's all subjective. It's discretionary with no order, right? So that would lead to random action, that would lead to low probability trades. So the first thing that could be a good one to do is to define what's your objective. Are you trading for income generation? Are you trying to catch direction for speculation purposes? Are you trying to protect a portfolio that you have running for a while? What are you trying to do? Your definition for objective may set your strike selections, knowing that generically we know that at the money options are going to provide in more delta, so they are higher probability but also higher cost, whereas out of the money options they're going to be cheaper, but they also come with less delta and therefore also less probability, because they are out of the money and therefore their probability of becoming in the money is less, because in order to become in the money they first need to stop being out of the money, which requires the stock to move by a certain amount. That's why they're cheaper, right? Again, maybe your philosophy is it's all about reward to risk ratios in your methodology, and you are okay trading out of the money options as long as it's not too far out, and you have rules around how much is your minimum delta, things of that sort. And again, you just do this consistently, and you know why you do it, and you know it works. So then not a problem, okay? But you have to have rules. It would not make sense that trade number one, you trade at the money, trade number two, suddenly you decided, let's do it out of the money now. I feel the options are too expensive. And it's just a subjective feel, again, probably led by trading emotions. Engineering your expiration is critical. Options have an expiration date. Not giving yourself enough time to get to your target obviously is going to kill your profits. Remember, extrinsic value decays, and therefore the selection of expiration date is critical. In the following slide, we're going to review the method that we use using ATR. But yeah, again, it's critical that we are careful at selecting expiration dates. Risk and reward hard coding, right? So we need to calculate how many contracts do we use per trade in a way that it predetermines, if we were to lose, how many dollars we lost. And that number is not about how you feel. That number is predefined, and we need to do the math, let's say with a calculator, so there are no mistakes being made. And if the math says you can go with 4.8 contracts, you don't trade 5, you trade 4. Always conservative with the size, so you manage risk. So to engineer the expiration date, we need to calculate our time to target. One approach to calculating time to target without getting complicated is to use ATR. Here I have an example with NVIDIA. Let's say you just purchase a call on NVIDIA and you plan to ride NVIDIA from 177.39 all the way to this high at, let's call it 195. Okay, so you plan to reach 195 with that stock. So if I look at the distance between 195 to the current price, basically what we are saying is that we are planning to ride a $17.61 move. That's what we are planning to do. And the question is, what's my time to target? How likely this move is likely going to last? So the way to have an estimation is to look at the ATR, which currently shows as 544. So we take that number divided by 5.44, that is 3.23. And that means that if every day we was the maximum move, or the average move I should say, moving only up in the direction of the target, you may get to the target in 3 days, 0.23. Okay, but that means that every day the market has to go up. No breathers, no changing direction, no nothing, just go up all the way, which is not reasonable. So one thing that we discussed in a prior video lesson is to multiply this times 7. So we convert 3.23 days in 3.23 weeks, which is 22 days. And the reason why we do that is because the estimation is that in a week, we are netting 1 ATR to the upside. You could think about market goes up, and then next day it goes down, and then next day it goes up, and then next day it goes down, and then the last day of the week, Monday to Friday, then it went up. So you have 3 ATRs up, 2 ATRs down, so you are netting 1 ATR up per week. So that's 22 days. Let's call it 23 days. So now you will look at the expiration date, and you would see that 20 something, that's going to be 28. That would be your expiration date for this trade. Okay? That's how you can do it. Of course, there are many other ways on how to approach deciding on your expiration date. If you give yourself more time, of course, you're going to have a slower time decay. But of course, the option will cost you more. So it's a balancing act, and for sure, you can certainly trade variations of the references I'm giving you in these video lessons, because to be honest, the sky is the limit. Things can be done in a multitude of ways. Now, for you to trade, you need capital. So let's say your account has $100,000. That number, instead of in dollar value, you should now start thinking about it in percentage. And no matter what your number is, maybe your number is 1,000 or 10,000 or 1,000,000, it doesn't matter what the number is, you should think about it in percentages and break down into pieces, which we're going to call allocations. So you may have 10% for you to allocate trades where you're going to be buying calls. Another 10% maybe is going to be for stocks in the biotech industry. Another 10% is going to be for ETFs related to commodities. And you have a specific strategy allocation where you took your capital and using percentages, you break it down into pieces. It's almost if you had multiple trading accounts, even though you may have all your capital in one account. Now that you have multiple pieces of the puzzle defined, for each piece of the puzzle, you're going to have to decide on what's the maximum risk you take per trade. So let's say out of 100,000, 10% is for long calls. So now 10% of 100,000 is 10,000. So now you're going to be using $10,000 for the long calls, okay? And you now need to think about what's the percentage risk I want to take by looking at this value as a reference. So let's say you decided you want to risk 1%, 2%. So 1% of 100,000, okay, that's going to be $1,000. So now you got 10%, which is going to be used, 10% of 100,000 is 10K. This is going to be used to buy calls, but you can only risk 1,000. Okay, you can only risk 1,000, which is your 1% of 100K. Okay, so you have extra capital, which also allows you to run multiple trades in parallel in that bucket, in that specific allocation. But we need to keep all those numbers in mind. And those numbers are not to be decided on the fly. This is something that is done. Maybe you decided on your risk strategy over the weekend when the markets are closed and you are cool and you had a nice meal and then you took a nap and then you were very well rested and you took a nice coffee and you were very well awake, very relaxed, and now you decided on those values. And those values are going to be hard coded and you never break these values. Okay, that's very critical. So now, let's say you identified an asset moving very rapidly in your favor, okay? Moving very rapidly in your favor, okay? Like this, moving very rapidly in your favor. So let's say you have identified that asset. You could decide to scale out gradually as the stock is moving up. Instead of waiting to get all the way to the moon and sell then, which that would be fantastic, but we may not get to the moon. We may get to the clouds, but not the moon. So then another possibility could be to scale out. I'm going to show you this in just a second. Now, what if the asset moves against you? Okay, you may decide to leave the call alone, and you know the most you can lose is the premium paid, so you just leave it alone and that's it. Or maybe no, maybe you're going to use a stop loss on the call. If you surpass a certain level, you're going to go and close the call manually for a loss, and therefore you are losing much less than the maximum amount you wanted to risk. But you may have a technical reason why you want to exit. Maybe you bought a call because there was a breakout of a support, and the support is called support for a reason. You expected to support price, but now the market went and violated the support. So then, to be honest, you don't have a reason to stay in the trade unless you now hope, which is obviously not the best recommendation, isn't it? So you may now decide, okay, I'm just going to exit the trade, and that would be a stop loss, and then you were risking maybe 1,000 and you exited the trade maybe for $300 of loss. So it's still a loss, but you keep minimizing that loss, which is a great practice for risk management. Scenario C, maybe you didn't do this trade with a long call. Maybe you were selling cash secure puts. So the asset dropped enough for you to be assigned. So what do? You accept the share assignment. To be honest, you cannot do anything else. It's an obligation. And then you turn around and you sell cover calls against to generate yield against the acquired asset. So again, those rules need to be in place and act on them religiously. Now, here's the example of what we're talking about. The stock goes up, impulses, corrects or pauses, impulses, corrects or pauses, reaches to your first exit. A good practice could be to close half of the position and leave the other half for higher potential profits. And maybe when you get higher, you close half of the half, and then at the end, you close the remaining half of the half, right? 25%. So that could be another possibility. And to be honest, it's good, not only from a risk management point of view, but it's also good for the psychology. That really depends on who you are as a trader and what's your psychology. But it works very well with many traders in the sense that it's reinforcing positively your confidence level because you are collecting profits as you go. And while that's happening, maybe another stock lost money for you. Soon enough, you collected another profit with that stock, and it helps to keep the confidence and the motivation high, which it's obviously important to do. Now, you went to the end. What do we do? And I'm going to revisit a full example with a bit more detail in a moment, okay? But now you went to the end. What do? You log the trade so later on you can review. This is a super summarized, super simplistic example of how you can log. But basically here you are buying a call on a specific stock, XYZ. You did this trade with 3 contracts. You had $900 of risk. You made $2,100. Why did you do it? It was a momentum breakout. That was where the underlying was at the entry and the exit. And then once you log all of these, not only you have the numbers, where then you can calculate your trading statistics, which is great, such as I profit 58% of the times. My average reward to risk ratio is 2.1 to 1. I got 142 trades so far. So all of this is great, but you can also then review the human component, if you wish, and ask yourself questions such as, did the setup meet all checklist criteria? Was the size within the funnel limits? Was the exit pre-planned? So a losing trade that followed the system perfectly is a good trade, whereas a winning trade that broke the risk rules, it made money, thank you very much, but that's a bad trade, recipe to build a very bad habit that may end up creating many bad trades that actually will end up as a loss, okay, many more times. So it's important to review so we can not only document what's happening, but beyond documenting, looking also at the human component on our trading activity. And no need to say, you probably know that trading emotions play such an important role in trading, and not having a log basically would put you in a either fearful state or overconfident state, and you would not be objective on understanding who are you as a trader, okay? So very important. So anyway, let's go for stock XYZ. The stock is trading at 100, breaking up. Let's say at this moment in time, you want to enter on a trade and you decided to buy a call. So you buy the 100 call at the money with an expiration date 45 days to go. You calculated that with the time to target. Your target is 110 all the way here. So you buy the call and the cost of the call is $3 per contract times 100. That would be $300 of risk per contract. So that's the trade. That's what we have. That's the cost of the call. And that's what the underlying was doing at the time of the trade. So let's say you have a total account equity of 50,000. Let's say your risk appetite based on the 1 to 2% rule we covered a moment ago is 2%. So 2% of 50K is $1,000. This is the maximum allowable loss per trade at this moment in time. So what do? You know that every time you take a trade buying that call that would cost you $300 per contract, you have that risk. But you also know you could risk up to 1,000. So you take 1,000 divided by 300, and it tells you, the basic math tells you that you could take this trade and use 3.33 contracts. Again, you cannot trade 3.33 contracts. It's either going to be 3 or 4. Of course, we always round down, and therefore we purchased strictly 3 contracts. So the capital risk is actually 900, which is less than 1,000, but that's okay. We don't go above 1,000. It's okay to stay below. Now what? Let's say the stock after a few days jumps to 105. It hasn't reached our target of 110 yet, but is already moving to 105. And let's say at that moment in time, the call is trading at $5. You got 3 calls and they are now trading at $5. Remember, we purchased the calls at $3. They are now trading at 5. So each call, it's giving you, if you were to close it now, each call is giving you a profit of $2. From 3 to 5 is $2. So what can you do? You can close those 2 contracts, collect $1,000 minus the $300 that you paid. That will give you a temporary net profit of $400. Okay, you made $2 times 2, that's $400. So you are now in a position where you made $400 and you are left with one call in the trade that cost you 3, because you had 3 calls at the beginning, you closed 2, you are left with 1, and it cost you 3. So what's the most you can lose with that call? The most you can lose is $300, but you just made 400. So what's your risk now? The risk is no risk. The risk is, the worst case scenario is that you're gonna make 100. That's the worst case scenario. Now, a few days later, day 20, we do hit 110. It didn't take 45 days, it only took 20, but we got there. So at that time, the call is trading at $8. So you bought it at 3, you can sell it at 8. That would be $500 of profit on top of the prior $400 you got. So in other words, you made 900. Okay, so you sell the contract. Okay, you made 900. This is the profit of the trade, and you go find another trade, and this one you make sure that you put it in your journal and you log it. Very good. Systematize the plan. You make sure that you need to align your market outlook to the exact mathematical tool. What I mean by mathematical tool is that option strategies provide you with risk profile, right? You have those risk profiles that we discussed before. So this is how a long call would look like, for example. That risk profile, that's the math. So align the market outlook to that. Okay, if the market is looking that it's going up, that's what you need. If the market is looking like it's going to be sideways, maybe you need a color. Okay, so you use basic directional or non-directional strategies to express your view simply. Don't make it complicated. Now you have it. The next question is how many contracts? Size is the key, right? How many contracts do we need? You do the math. Remember, you have a specific portfolio size. You calculated your 1%, 2%, whichever amount, 0.5% if you're more conservative. You will decide a number, and with that number in mind, you now know that you could risk X amount. For example, $1,000 would allow you to buy 1 call, 2 calls, 5 calls, 20 calls, depending on the call price, which depends on the implied volatility and the price of the asset. And you just go with whatever number creates a risk which is adequate given your risk decisions. Okay, and then finally you audit the mine. So the trades are over for a profit or for a loss. You log it, you journal it, and you review it. Consistency in action dictates consistency in results. I guess it's obvious, I guess it's common sense, and I would think that anyone attending this video lesson would agree with that, because consistency in results by having random action requires luck. And while we could be lucky at times, luck does not last forever. So your maximum priority in trading should be your risk management, but know that the risk management is not only the markets or options, the risk is also you. So we need to audit ourselves, we need to manage the risk against ourselves, and one very healthy way to do this is utilizing journaling and logging your trades, so then you can go ahead and review and basically have a very clear understanding of the things you did right and the things you did wrong. Very well. Options give you options, my friends. I believe that after going through a number of video lessons, this is pretty clear now. Of course, so far I have been sharing a lot of knowledge with you. Knowledge is very important, but the real power comes when the knowledge transforms into skill. And to have that skill developed, it requires practice. So either with your paper money account built in the Webull desktop or mobile app, or with real capital starting with limited size as you develop your option skills, practice is obviously something that will make you this super options trader that you are already, or you may plan to be at some point, which is why you are attending these video lessons, and hopefully my part is helping you there, but definitely counting on you as well to keep up the good work and while you manage your risk, to put practice in place so you can develop those skills to become something truly powerful. Keep in mind that options give you options.